Have you ever felt that knot in your stomach watching the stock market soar while you're on the sidelines, waiting for the perfect moment to jump in? You tell yourself you'll wait for the next dip. You'll buy when things are on sale. It sounds smart, right? Buy low, sell high. But what if this seemingly brilliant strategy is actually keeping you from building real wealth? What if buying the dip is a trap? Today, we're settling the score between two legendary investing strategies. In one corner, we have the flashy buying the dip. In the other, we have its quiet, disciplined opponent, dollar cost averaging. By the end of this video, you'll understand which strategy builds more wealth and discover the single most important factor that separates successful investors from everyone else. Let's be honest. Buying the dip is incredibly appealing. It feels like you're outsmarting the system. You're the savvy shopper waiting for a flash sale. Everyone else is panic selling, but not you. You're waiting patiently to strike when there's blood in the streets. This strategy plays directly into our desires for control and getting a deal. It makes you feel like a Wall Street genius from home. You see the market drop 5%, 10%, and you think, this is it. This is my chance. You swoop in, buy stock, and watch as the market hopefully recovers. But here's the uncomfortable truth. To successfully buy the dip, you have to be right twice. First, you must correctly predict that the market will dip. Second, you must correctly predict where the bottom is. You have to know when to get in. Think about that. The entire global financial system, with trillions of dollars and millions of the world's smartest minds competing, and you think you can consistently predict its short-term movements? It's like catching a falling knife. You might get lucky once or twice, but you're far more likely to get hurt. Let's look at the data. One study ran a simulation over 5 years, from late 2020 to late 2025. The study compared two investors, each with $100 to invest every month. One investor only bought the dip. He set a rule: invest only when the market dropped 5% below its recent average. The other investor just invested $100 on the first day of every month. What happened? Over 5 years, the market had plenty of dips. The dip buyer felt that rush of buying on sale several times. But here's the shocking part. The buy the dip strategy only triggered 17 times over 61 months. For over 70% of the time, the money sat on the sidelines in cash, doing nothing. While waiting for the perfect moment, the market was climbing higher. They were so focused on catching dips that they missed the mountain. This is called cash drag. Your money isn't working for you. It's sitting there, losing purchasing power to inflation, while the market continues upward without you. At the end of 5 years, the dip buyer had significant money still in cash, waiting for a dip that never came. The result? The investor who bought automatically every month ended up with a portfolio worth nearly 4% more. They didn't try to outsmart the market. They just showed up consistently and let time do the work. Another massive analysis looked at 75 years of market data, from 1950 to 2025. The result was the same. An investor who automatically invested every day ended up with more money than an investor who waited to buy dips. Why does this myth persist? Because it's a great story about being smarter than average. But investing isn't about ego. It's about building wealth. The data is clear. Waiting for the perfect moment is a fool's errand. Now we turn to dollar cost averaging. If buying the dip is the flashy acrobat, dollar cost averaging is the stoic giant in the corner. It doesn't get headlines. It doesn't make exciting party stories. But it is relentlessly, powerfully effective. What is it? Dollar cost averaging is investing a fixed amount at regular intervals, regardless of what the market is doing. It could be $100 every month, $50 every week, or $1,000 every quarter. The amount and frequency matter less than the consistency. When you use dollar cost averaging, you automatically buy more shares when prices are low and fewer when prices are high. Let's break that down. Imagine investing $100 every month into your favorite index fund. Month 1. Price is $10 per share. Your $100 buys 10 shares. Month 2. Market dips. Price drops to $5. Your $100 buys 20 shares. Month 3. Market rallies. Price shoots to $20. Your $100 buys 5 shares. After 3 months, you invested $300 and own 35 shares. Your average cost per share is about $8.57. Look at that. The price went from $10 to $5 to $20, but your average cost is lower than the starting price. You automatically took advantage of the dip without thinking about it. You bought more when it was cheap. When the price was high, you protected yourself by buying less. This is the quiet magic of dollar cost averaging. It automates the buy low principle without requiring you to be a market psychic. But the real power isn't just mathematical. It's psychological. Think about the stress of trying to buy the dip. Every day you watch the market. You wonder if this is the dip. Should you buy now? What if it goes lower? You're trapped in second guessing and decision fatigue. Now think about the consistent investor. They set up automatic investment and moved on with life. They weren't worried about daily market noise. They were playing the long game, building discipline, removing emotion from the equation. This is the greatest benefit of dollar cost averaging. It protects you from your worst enemy, yourself. We are emotional creatures. When the market crashes, our instincts scream to sell. When the market soars, our fear of missing out kicks in, and we're tempted to throw everything in at the top. Dollar cost averaging acts as a guardrail against these destructive impulses. It builds a habit. Just like brushing your teeth or going to the gym, investing becomes a non-negotiable part of your routine. Month in and month out, rain or shine. Over years and decades, that simple habit builds extraordinary wealth. So why does a simple, consistent strategy like dollar cost averaging almost always beat buying the dip? The answer is the cost of being out of the market. Research from Charles Schwab delivered a knockout punch to market timing. They imagined 4 investors over a long period. One was a perfect market timer, investing at the absolute bottom every year. Another was terrible, investing at the peak every year. The third invested immediately at the start of each year. The fourth was a procrastinator who kept waiting and never invested, staying in cash. The results were stunning. The perfect timer did best. But the person who invested immediately and the person with the worst timing were neck and neck. The difference was surprisingly small. However, the investor with the worst possible timing still ended up with hundreds of thousands of dollars more than the procrastinator who stayed in cash. Even if you invest at the peak every year, you're still vastly better off than someone waiting for the perfect dip. The biggest risk in investing is not buying at the wrong time. It's not investing at all. When you try to buy the dip, you spend most of your time out of the market. You're a procrastinator by design. You're betting you can make up for lost time by swooping in at the perfect moment. But the data shows this is a losing bet. JP Morgan found that if you missed just the top 10 best days in the stock market over 20 years, your total returns would be cut in half. Those best days often happen right after the worst days, during extreme volatility when dip buyers are still waiting for dust to settle. This is why consistency is the secret weapon. Dollar cost averaging ensures you're in the market. You're there to capture explosive upswings. You're there to benefit from the long march of economic growth. Buying the dip is based on fear and greed. You're afraid of buying at the top and greedy for a discount. Dollar cost averaging is based on discipline and humility. You're disciplined enough to stick to a plan and humble enough to admit you cannot predict the future. Ultimately, the choice comes down to a fundamental mindset shift. Are you a gambler or a builder? The gambler is drawn to the thrill of buying the dip. They're looking for that one big score. They see the market as a casino. Their focus is short-term, on outsmarting everyone. This mindset is exhausting. It requires constant vigilance, an iron stomach, and an ego that can handle being wrong most of the time. It's a recipe for stress and financial disappointment. The builder adopts the dollar cost averaging approach. They see the market not as a casino, but as a tool for long-term wealth creation. They're not trying to score a quick win. They're methodically laying bricks to construct a solid financial future. Their focus is on what they can control: savings rate, consistency, patience. They're playing a different game. It's calmer, more confident, and ultimately more profitable. This mindset shift extends beyond your portfolio. When you stop worrying about daily market gyrations, you free up incredible mental and emotional energy. You can channel that into your career, your side hustle, your family, your health. You start focusing on increasing your income, which gives you more money to invest, creating a powerful cycle. You're no longer a passive spectator. You're an active architect of your success. Adopting dollar cost averaging is a declaration. It's a statement that you believe in long-term economic growth. It's a commitment to your future self. It's trading the fleeting excitement of a gamble for the profound satisfaction of building something that lasts. You might be thinking, this is great for monthly savings, but what if you just received a large sum? Maybe an inheritance, a bonus, or property sale. Should you invest it all at once or use dollar cost averaging? This is the classic lump sum versus dollar cost averaging scenario. Statistically, lump sum investing has outperformed dollar cost averaging about 2/3 of the time. The reason is simple: the market goes up over the long term. The sooner your money is fully invested, the more time it has to grow. Time in the market is the most powerful force in investing. However, this doesn't mean lump sum is always right for everyone. We're not robots. We're humans with emotions. Imagine you invest $100,000 today, and tomorrow the market crashes 20%. How would you feel? For most people, that would be devastating. You'd be filled with regret and might panic sell at the bottom, locking in losses. This is where dollar cost averaging can be powerful with a lump sum. By investing in smaller chunks over 6 or 12 months, you're psychologically hedging. If the market goes up, you feel good because part of your money is already invested and growing. If the market goes down, you feel great because you have cash ready to buy more shares cheaper. You're smoothing your emotional ride. You might give up a small amount of potential return, but what you gain in peace of mind and the ability to stick with your plan is priceless. For many people, Dollar cost averaging with a lump sum is the perfect compromise between getting money to work and protecting from emotional fallout of a sudden downturn. After all this, what's the final verdict between buying the dip and dollar cost averaging? While buying the dip offers the tantalizing promise of outsmarting the market, the evidence is overwhelming. It's incredibly difficult to execute, fraught with psychological traps, and over the long run, less effective than its boring counterpart. Dollar cost averaging emerges as the clear champion, not because it's flashy or exciting, but because it's built on timeless principles of discipline, consistency, and humility. It's a strategy that works with human nature, not against it. It automates good decisions, removes emotional bias, and ensures your most valuable asset, time, is always working in your favor. The key takeaway is not that you should never buy a dip if you have extra cash. The key takeaway is that your core investment strategy should not depend on your ability to predict the future. Your path to financial freedom is paved with the steady, consistent, disciplined habit of investing month after month, year after year. It's about your mindset. It's about choosing to be a builder, not a gambler. So ask yourself, which path are you on? Are you still waiting on the sidelines? Or are you ready to start laying the bricks of your financial future? Thank you for watching. If this video helped you gain clarity, hit that like button and subscribe for more content that empowers you to build financial freedom.